Hello there. Welcome to the fourth lecture of the model series. During this lecture, we're going to look at the topic called application. During this lecture, we're going to apply what has been shared thus far within the model series to the real charts and see whether or not there are any repeating phenomena that are occurring with regards to our sequences of events that we are looking at. So here's the risk disclaimer that I'm forced to share with you before every single lecture. TOTK is not a trading advisor or an investment advisor. All we do is share our own knowledge and our own experiences for educational and/or entertainment purposes only. If you're interested in reading the full risk disclaimer and the terms of services that you agreed upon when joining the mentorship or joining TOTK, you can do so by going to our website, theonesthatknow.com, and you can read them in great detail. To begin this lecture, we're first going to take a look at the table of contents. During this lecture, we will discuss the London session, the morning session, and the afternoon session. The goal of this lecture is to show you how applicable the theory is that has been shared thus far within the model series. It's important to note that this is not me giving you any financial advice. All I'm sharing with you is repeating phenomena that occur within the algorithmic delivery of price. And these are my own findings, and I'm sharing my findings with you. So as we know, this is the schematic that we have been working with ever since the release of the first lecture. This is what occurs inside of a bullish market, inside of bullish order flow, aka a market maker buy model. We want to see the market sell off into our point of interest, and we want to see our point of interest get reached during 2:30 a.m. to 4 a.m. That's the sweet spot for the London session. From there on, we want to see a smart money reversal form, and the market maker buy model should unfold as we know it should unfold. For the bearish order flow, for the bearish market environment, we are looking for the following. We are looking for repricing higher, buy-side delivery into a point of interest, which should be reached during 2:30 to 4 a.m. And from there on, we are anticipating a smart money reversal to form. And if it does, we are anticipating sell side to be the draw. So let us now take a look at the first chart example of the London session. As you can see, the reference points for the London session are first of all the Asia buy side, so it means the Asia high and the Asia low. During this lecture, I will make use of boxes that showcase the sessions. So in this case, the Asia session is plotted in blue and the London session is plotted in red. What we can see is that from the midnight opening, the market gets repriced higher above the Asia buy side. And now the question arises, how high can it go? How high could it potentially run before reverting? Well, first of all, we must pay attention to time. As you can see, this all occurred during the beginning of the day, even between our sweet spot. So therefore, it is anticipated that the market can at least draw a bit higher into a premium of the current dealing range, and then at the right time form a smart money reversal to then deliver towards sell side liquidity below the Asia low firstly and below the low right here. If we zoom in into the lower time frames, we can see the following. We can see that between 2:30 to 4 a.m. the following delivery occurred. What we see is that the market got repriced higher above what? Above the buy side liquidity engineered above these relatively equal highs. This is a point of interest inside of an already existing point of interest, meaning because we already trade above the Asia buy side liquidity, our mind is drawn towards shorts. Now we're looking for a run on buy stops, buy side liquidity being engineered above these highs, to then displace lower, confirm a sell program and draw lower, because we know that the higher time frame order flow is bearish. And now my question to you is the following. On this chart, what confirms to you that the change in the state of delivery has occurred after we have purged the buy side liquidity here? And what confirms that we can now anticipate lower prices to be next? I'm going to give you about 10 seconds, so please pause the video, because you don't want to ruin this learning experience for yourself. Alright, let's take a look. First of all, our eye is drawn to this down close candle. Why this down close candle, you might be wondering. Well, this down close candle is a bearish breaker. Why is this a bearish breaker? Well, we see a high form here, a low, higher high, lower low. So now we anticipate that down closed candle to act as resistance on price. Now notice that the moment that price traded into the price range of this down closed candle, the bodies never closed outside of it. But from what point on was the market allowed to expand lower? The moment that price displaced below it, so it closed outside of it, retraced, offered buy side, boom, there it goes. And from there on we see a sell program unfold. Let's now take a look at the second example. Here we can see the Asia range annotated again or plotted in blue. What we can see is that the Asia sell side got taken right here by this long wick, this manipulation, this purchase sell side liquidity. So what can we anticipate now? We can anticipate the market to at least retrace into the range that is currently present. So the range being from this high to this low. Why that range, you might be wondering? Well, that's the range of the current day, because the day opened up here at the true day open, midnight opening price. So therefore we can anticipate a run towards buy side liquidity back into that range. What we see is that a new high of London gets created. This was the initial high. They sent it lower. They made it go lower towards the Asia sell side. What does everyone think? Lower prices are next. What do? They short. So what is smart money doing right here? They're buying every single manipulation wick lower. Why? Because they know that the market is predetermined to go higher for this day. Because the higher time frame order flow is bullish. If we take a look at the M1 time frame, we can see the following. Between 2:30 to 4, a consolidation occurred initially. Market went sideways. What's the function of this consolidation? It's engineering sell side liquidity above the Asia sell side. What then occurs is that the market purchases the sell side liquidity below these lows and below the Asia sell side, and then it reverts higher. Now my question to you is the following. What confirms the change in the state of delivery after we have purchased the Asia sell side? We look at the left side of the curve. What confirms the change in the state of delivery is the following. It's first of all the market trading above this CB. Why that CB? Well, if price was going to continue lower, it should have found resistance inside that CB and then continue lower. Instead, it displaced above it, and from there on, we can see that higher prices are next. But secondly, something else is crucial inside of this delivery. The market displaced above the CB above there as well. So what are we seeing? We are seeing the first CB get overrun and the second CB. Notice that when the second CB got overrun right here, the market closed inside of that CB, inversion of a value gap, before being allowed to continue higher. Notice that this is all one big market make and buy model during the London session. Original consolidation being above these highs here. Point of interest, Asia low. The Asia low got run during the right time of the day. Market displaces, boom, buy program unfolds. Very sloppy delivery though. But for the viewer that's paying close attention, he or she might notice something different inside of this delivery. And that's the following. Inside of this delivery, we do not see only CBs that get overrun, but we also see this up close candle get overrun. And this up close candle is significant because if we're bearish, we want to see up close candles begin to act as resistance on price once broken. But because our point of interest, the Asia sell side, the Asia low, was reached and we saw a purge of that sell side liquidity occur, and the market then displaces above this up close candle, we can now confidently say, okay, order flow has shifted and we're now going to look for down close candles to act as support on price. If we're bearish, we're looking for up close candles to act as resistance on price, and if we're bullish, we're looking for down close candles to act as support on price. Let's take a look at the third example. The third example is the following. As you can see, the Asia buy side liquidity is plotted again right here above this high, Notice relatively equal highs during the Asia session, got the left intact. Same scenario basically as the first example, where we see that during the beginning of the London session, the market already purchased the buy-side liquidity of Asia. But is the market already allowed time-wise to expand? No. Why not? Because it's waiting for 2:30 to 4 a.m. So therefore we see consolidation, market opens up at 2 a.m. of a sell side here. What is the function of that delivery lower? It's manipulation. They trap shorters into believing that London is gonna go lower. They push it higher once more, trapping buyers, taking out buy-side liquidity. And this is where smart money sells during the right time of day, targeting sell-side liquidity below the Asia low and below the trend line liquidity engineered below these lows. If we take a look at the M1 time frame, we can see the following. Here we can see that delivery lower from the 2 a.m. open. Sell-side delivery leaving intact relatively equal lows, market expands higher. And at what time does the high of the London session form? Look close. Near 2:30. From there on, we see this CB act as resistance on price. This signals bearish order flow, the fact it's not getting broken after we have seen this low get violated. We then see another displacement leg lower after 3 a.m. 3 a.m. is a significant time window, 3 to 4 to be precise. CB market retraces into that for buy side, time distortion inside of it, and there it goes lower. New CB, significant, distributes lower, targeting the Asia sell side, which is below the low of this blue box. If we take a look at this CB, here we can see it annotated on the chart. Second BC here, which is an inversion for value gap. Why is it significant? Think back to the model series. What is being shared right here? When discount arrays on the left side of the curve are failing to act as support if bullish on price, then it's a sign that order flow is potentially switching and that we could anticipate lower prices to be next. What we see is that when this big down close candle displays through that BC, there's this large manipulation wick higher into what? Into the high of that BC, into the high of that inversion for value gap. So let's say that you went short right here inside of the CB. Where would your stop be? Your stop would be above the high of this indecisive candle, because that indecisive candle is the invalidation if price is going to fall over. You cannot place your stop at the high of the CB because of this inversion for value gap. Price might retrace into that before continuing lower. And finally, the third relevant box is the following. This down close candle is a bearish breaker. Why is it a bearish breaker? Because we see a high form right here, low, higher high. This low set up the run towards the buy side liquidity. This low was the low that set up the run before the right time of day came around and the market was allowed to reverse. Notice that this low got broken by a CB. So you have a bearish breaker with a CB. Something we like to see at the right time of day. So let us now take a look at the New York session. The New York session bullish order flow model looks like the following. It's a market maker buy model. What we see is that sell side delivery occurs into a point of interest during the right time of the AM session. During 9:30 to 10:30 AM, we want to see the point of interest get reached, smart money reversal form, market should expand higher once the smart money reversal is in. If we take a look at the bearish scenario within the bearish environment, bearish order flow, and we can see that repricing higher occurs into the point of interest between 9:30 to 10:30. Market forms a smart money reversal there, and then it distributes lower, targeting sell side liquidity. So here we are on the 15-minute chart, and as you can see, I have annotated equal lows engineered during the New York morning session. The reason why these equal lows have been engineered is because at the time of these equal lows being engineered, it was significant, because these lows are lows of time cycles, 90-minute cycles to be precise. what we see is that the market purchases those equal lows right here and then distributes higher because the higher time frame order flow is bullish. Therefore, any leg lower purchasing sell side is manipulation, and inside of this delivery higher, there's a fractal market maker buy model. Point of interest being the liquidity below these lows and specifically this BC. If we take a look at the 1 minute time frame, we can see the following. We know that the first AM cycle is from 7 to 8:30 AM. The second AM cycle is from 8:30 to 10 AM. What we see is the following. We can see that these equal lows got engineered, and then from around 9:30 the market got repriced higher. That's significant because our higher time frame order flow is bullish. And now think back to the two 9:30 opening profiles that I shared with you. If 9:30 runs in our favor, we want to see, if bullish, a false high get formed. That high traps people into believing that, okay, we're gonna go lower now. So what do? They go short, they place their stop losses above that high. And what then occurs is that the market gets ran into the opposite direction of what we're anticipating. So we have established a bullish bias for this market, we are looking for higher prices, and we then see the market opened up, form a high right here, so it goes higher, and we think to ourselves, okay, it's bullish, right? While what occurs is that they then distribute it lower because they need to purge sell-side liquidity before they are allowed to make it go higher. So what occurs is that this high gets engineered here, false high, gets utilized to reprice lower. Traders that sell on the breakout, they sell the moment that price trades below these relatively lows. They think support gets broken. Market spends some time below there before it finally begins to displace to the upside and expand higher. This is all occurring during the right time of the morning session, during the right time of day, 9:30 to 10:30 AM. Now, pay close attention to the delivery here. What confirmed the change in state of delivery? The moment that price closed above this up-close candle or traded above it, the change in state of delivery was confirmed. Why? Because this is a bullish breaker. We see a low form below that AM1 sell-side liquidity, high, lower low, higher high. We now anticipate this up-close candle to act as support on price moving forward. Notice that price stepped into it here and then never revisited that area again. Why not, you might be wondering? Because of this up-close candle right here. This acts as support on price, and more specifically the CB, in which that high formed that up-close candle. This trade was taken by me, and if you want to see the recording, the execution video, you can go on the mentorship platform and you can see on what day this was, and you'll be able to get the breakdown somewhere in the middle of January. And here we can see that inversion for value gap doing its thing on price. Here we are at the second example of the morning session, and as you can see, I have annotated both the London sell side as the London buy side liquidity. London low and London high are important during the morning session. What occurs is that around 9 o'clock during the second AM cycle, the market taps below the London sell side, but notice that this is not a real purge. It's just forming or engineering more liquidity, more sell-side liquidity. What occurs is that during the third 90-minute cycle for the morning session, the market opens up, distributes lower, it manipulates, trapping people into believing that the markets are going to go lower. Below the AM2 sell-side liquidity and below the London sell-side liquidity, smart money goes long, fractal market maker buy model back into the range of the day thus far, the London high to the low of this candle right here. If we take a look at the 1 minute time frame, we can see the following. We can see that during the second 90-minute cycle, the market traded just below the London low, but notice that the bodies are closing above it. This means that the sell side liquidity is being engineered. Because the wicks do the damage, the bodies tell the story. And in the case of engineering of liquidity, when the bodies close at the exact same price level that you had marked up on your charts as a point of interest, it's a sign that the real purchase is yet to occur. We then see that the market gets repriced higher. At 9:30, the market gets repriced higher again. What's the function of that repricing higher? It traps people into believing that we're going to go for longs during the morning session. What occurs is that a high forms, market then runs lower. Those people that were just long think, okay, it's now going to go short. Let's go short. Where do they place their stop losses? Above the high of the second AM cycle. Market distributes lower into what? Into the sell side liquidity below this low and below the London sell side. But at what time? At exactly 10 AM, the manipulation begins. Lower, low forms, buy program unfolds, targeting the buy side liquidity above this high. Again, this is all occurring between 9:30 to 10:30. And what we have seen thus far is that 9:30 opened up into the anticipated direction and it forms a fake high. Then we see manipulation lower against the anticipated direction. This is what we want to see. This is the sell side of the curve into our point of interest, which gets reached during the right time of day. And from there on, we can see a smart money reversal form and the buy program begins. Smart money reversal gets confirmed the moment that price displaces or trades above this high. Why this high specifically? Because this high formed inside of the CB and set up the final run lower, purging sell side liquidity to then revert it higher. Notice that in the price lag from low to high, so the displacement lag of these candles, first candle, second candle, third candle, fourth candle, there's a BC that forms. I apologize. A bullish or value gap here. Market retraces into that. Institutional order for entry drill, IFET. Boom, there it goes. Market forms a new high. It retraces into what? Into this BC and into this candle right here. This whole CB is an inversion of a value gap. Left side of the curve being utilized as support on the right side of the curve. And from there on, we see higher prices next. Bullish order flow. Notice that the market falls short below the London buy side liquidity, and that's why you take partials accordingly above this buy side liquidity and so forth. This CB getting overrun was another sign of a change in state of delivery occurring. The moment that CB got overrun, it should have acted as support on price, as you can see it did. This was again a trade that I took live, and if you want to see the recording, you can do so by going to the 10th of January 2024. Here we can see the third example of the morning session. During this example, we can see that the London buy side liquidity got taken early during the morning session. Market got repriced higher aggressively, and this is, by the way, on the euro, so I'm showcasing to you that this works on Forex as well. You can see that repricing higher occurs from the opening of the New York session. Then the market purchase the second AM cycle's buy side liquidity, which got engineered above this high and then reverts lower, back into the range that got created during the morning session thus far. If we take a look at the 1 minute time frame, we can see the following. We can see that between 8:30 and 10 AM, the market got repriced higher. At 8:30, there was a news driver that got utilized for heavy repricing higher, choppy delivery, but the market gets repriced higher. Then a high gets formed between 8:30 to 10 AM, the market begins to manipulate higher, gets repriced higher. And then the moment that price comes above the second AM cycle's buy side liquidity, between 9:30 to 10:30, I apologize for not having it on my chart right here, but you can see that this is where 10:30 is and this is where 9:30 is. What we can see is that buy side liquidity gets taken, it gets purged, and the market begins to roll over back into the 8:30 news candle. Now, my question to you is the following. What confirmed the change in state of delivery above the second AM cycle's buy side liquidity? Take a good look and we'll then showcase it to you. This down close candle was a bearish breaker. Why was this a bearish breaker? Because we saw a high form, low, higher high, lower low. This low formed inside of what? Inside of this BC here. So this low is an intermediate term low. It should not get violated if price is going to continue higher. Inside of the leg that breaks through this low, we see a CB. Market retraces into that CB and then continues lower, drawing towards sell-side liquidity. Notice that the market swept the buy-side liquidity here already, but it had to make another run on buy-side liquidity. This is what we call a three drives pattern. When there are, for example, highs that are being engineered. In this case, there was a high that formed during 8:30 to 10. This was a significant buy-side liquidity pool. This is the first high, second high. So this high sweeps the liquidity of the first high, and then the third high sweeps the liquidity engineered during the sweep of the first high. So it sweeps the liquidity of the second high. This is what we call a three drives pattern. And if you take a look at your charts and at old historical market data, you will see that it occurs actually pretty often. Not something you should put emphasis on, but just something I wanted to share with you. As you can see, that inversion value gap acts as resistance on price once broken. And here we can see the final example of the morning session. This is a trade that I took during the morning session, a market maker sell model. This was shorting near the high of the Nasdaq thus far, so the all-time high. What occurred was the following. What we saw was that from the New York opening, the market got repriced higher, and it already took out the London buy side rather quickly. But it also took out the Asia buy-side liquidity, which got engineered around here. Notice that the previous day high left equal highs intact. What occurs is that the market trades above the previous day high, here, but it occurs too soon. It doesn't occur during our time window, because 9:30 was here. So what occurs is that the market gets pushed higher, 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 until it breaks above the old all-time high, which was around here. And between 9:30 to 10:30, the market rolls over and sell-side delivery follows on a Friday. If you want to listen to the full breakdown of this trade, you can take a look at the lecture that was shared on the 24th of February 2024. We're now just going to put emphasis on what has been taught so far within the model series. As you can see, the previous day high got taken. What's the nearest sell-side liquidity that we can potentially target? While the opposing side of the range thus far for today. London formed a low right here. New York formed a high right here. So what can we target? We can target the London sell-side liquidity. Here we can take a look at the 1 minute time frame, and as you can see, at 9:30 the market got repriced higher. When this occurs and 9:30 gets utilized to reprice into a point of interest, this is another scenario that was outlined during the previous lecture about the 9:30 opening profiles. When this occurs, we immediately begin to think, okay, this is probably going to be manipulation, because the market has been going higher for so long, and this key opening gets utilized to send it higher once more into our point of interest, into our drawn liquidity. And what we see is that between 9:30 to 10:30, market consolidates here, and it forms a high. What confirms the formation of this high is if this down close candle, sorry I did not outline it perfectly, but if this price range from basically this high to this low gets violated, gets displaced below, I am looking for sell side delivery to be next. I went short inside of this candle here, inside of the retracement. But why is this significant? Why this price range specifically? Because from this high to low, this price range got utilized to reprice into this BC, into the imbalance, which can be seen here. And once that gets broken, we know that a change in the state of delivery is likely to occur next. And from there on, we see sell side delivery occur, targeting sell side liquidity. Again, if you want to read the breakdown or listen to the breakdown of this trade in great detail, you can do so by going to the review of the 24th of February 2024. Let us now take a look again at the schematic, but now for the PM session. This schematic applies when we are in a bullish environment where there's bullish order flow present, and we anticipate higher prices for the PM session. What we want to see is that sell-side delivery occurs into a point of interest. Market should reach this point of interest between 1:30 p.m. to 2:30 p.m. This is our time of interest. From there on, we want to see repricing higher occur. So this is the buy side of the curve within a market maker buy model. If you take a look at the bearish order flow scenario, inside of a bearish market, inside of a bearish anticipation for the PM session, we are looking for the following. We're looking for repricing higher into a point of interest, which should get reached between 1:30 to 2:30 p.m. From there on, we want to see sell-side delivery occur, targeting lower prices. If we take a look at the schematic on this chart, we can see that there's a yellow box right here, which represents lunch. And then this purple box right here represents the New York PM session. What we can see is that lunch consolidated, New York PM sent it lower, repriced lower right here. This repricing lower traps people into believing that PM is going to continue lower after the AM session expanded lower. People go short here. What occurs is that the market runs on those stops, on those buy stops, trading above the lunch buy side liquidity, then begins to roll over, targeting sell side liquidity below all of the lows inside this leg higher. This is a purge of the lunch buy side, which is a scenario outlined for the PM session. The lunch buy side is a POI if we're bearish for the PM session. Take a closer look on the 1 minute time frame, we can see the following. We can see that the lunch buy side liquidity got engineered above this high, and here you can also see why I say that the lunch is from 11:30 to 1 instead of from 12 to 1. By saying that, many people say that because they think lunch hour, so therefore it must be 12 to 1. No, because if it was 12 to 1, why would this high be a relevant reference point on price? If you would extend this high, you can see that this high gets utilized through support and resistance going forward. That occurs because this is the real lunch high, 11:30 to 1. What occurs is that the market gets repriced above that buy side liquidity between 1:30 to 2:30, and it then begins to slowly fall over. Notice that this delivery is very choppy and it is not the preferred smart money reversal. However, I'm sharing this with you because it's important to not only have the cleanest possible deliveries, but to also see deliveries that are not that clean, but that follow the logic. The reason why that's important is because that's what it's like. You're not going to have the perfect day, every single week. But the logic is going to be usually pretty clear and pretty straightforward when the delivery occurs like this. And you will see that, okay, the PM scenario that we are looking for is a run on buy side liquidity between 1:30 to 2:30 p.m., specifically the lunch buy side liquidity. What we see is that buy side liquidity get taken, but notice how choppy this delivery lower is. And then once it begins to fall over, once the first CB forms right here, that's the first shorting opportunity. Second CB that forms, second short opportunity. And notice that after that, it just gets sent lower. Panic occurs. Oh, what is this? Why is this happening? What's occurring in the world? Blah, blah, blah. Panic arises, whilst in reality, the market is just doing what it's programmed and engineered to do. What confirms the change in state of delivery is the moment that price closed below this downcast candle, which is a bearish breaker. High right here, low, higher high, between what time? Between 1:30 to 2:30 p.m. If you close it between 1:50 to 2:10, yep, that's a macro during the PM session. We will discuss macros later on more in depth, because they are very significant within my analysis when it comes to determining what a real PD array is. Yep. Anyhow, market closes below this breaker. Notice that right here, the market closes below it. Notice that the closes are never above the low of the breaker anymore. Market gets sent lower, and there it goes, business done. Inversion of value gap on the left side of the curve acts as perfect resistance on price. This is how you gauge order flow. You look at the left side of the curve and how it's being treated on the right side of the curve. If discount arrays on the left side of the curve are acting as resistance on price, you now know that order flow has shifted bearish and that you can anticipate lower prices. Here we can take a look at the second example of the PM session. As you can see, launch buy side liquidity got engineered above this high and sell side liquidity got engineered below this low. At 1 p.m., which is the opening of the 90 minutes mind manipulation cycle of the PM session, the market opens up and it expands lower. What's the function of this expansion leg lower? This expansion leg traps retail shorters into believing that the launch is going to fall, so what do? They chase it. They go short, 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 short. What occurs? Market trades into a point of interest. Point of interest was already the launch sell side liquidity right here, but more so a discount of the range from AM to launch thus far. So from this low to this high. And from there on, we can see that buy side delivery occurs, targeting buy side liquidity above the launch buy side. If we take a look at the 1 minute time frame, we can see the following. We can see that at around 1 p.m. the market begins to expand higher. So this run higher has the same function as was what we have been discussing with the 9:30 opening profiles. It trades into our anticipated direction, into our expected direction. Why does that occur? Why is that relevant? Well, this run higher traps people into believing that, okay, well, we're going to trade higher during the PM session. That's our underlying narrative. But we understand that this occurs and can only occur when a deep discount gets reached before the expansion leg at the right time. And the right time is between 1:30 to 2:30 p.m. So we know that they trap buyers into chasing it right here. Then occurs is they run on those buyers. So that means that sell side liquidity rests below every single low here and basically below every single low inside this leg higher. Then sell side delivery occurs into a point of interest, gets reached between 1:30 to 2:30 p.m. More specifically around 1:45 and 1:50 to 2:10. Again, the 20-minute time window. Market displays to the upside. And now my question to you is, what confirms the change in the state of delivery here, and what confirms that buy side delivery was likely to be next? When the market traded above this upclose candle right here, which is a bullish breaker, we could anticipate the market now trading higher. What was more significant about this upclose candle was, first of all, that it formed inside of the CB here, but secondly, a BC formed inside of the price leg that traded above it. So we see the market retrace into that BC and then continues higher, comes back into the bullish breaker, spends some time around it, and then finally begins to expand higher. Why does this consolidation occur? Because we know that after consolidation, an expansion leg follows. Now we can take a look at the third example of the PM session, where we can see that we have annotated the launch buy side and the launch sell side liquidity. Now my question to you is the following. What could we potentially target if the launch range was rather large and we are bearish, we are anticipating lower prices? Well, what we can do is that we can measure premium to discount relative to the launch range. So from this high to this low. And then we know that equilibrium is around here. And the market will always try to retrace back into equilibrium before it begins its next move. When the launch is a large range, so it means the launch is an expansion, we can anticipate that. What we see is that a run on buy side liquidity occurs here, above the launch high, market reverts lower, but it never touches the launch low. Why not? Because the market was being held inside of a consolidation. So therefore, equilibrium was a good target, and of course the previous cycle's low. If we take a look at the 1 minute time frame, we can see the following. Launch high was above here. Between 1:30 to 2:30 p.m. the market got repriced above that high. above that buy side liquidity, and it then begins to roll over. Notice again that this is very choppy delivery. That doesn't matter. The logic still applies. The moment the price displays lower, we can now anticipate it to draw towards sell side liquidity. Where does sell side liquidity rest? Well, sell side liquidity rests below, first of all, these lows here, because these are the lows of the 90-minute cycle between 1 to 2:30 p.m. And we have an inefficiency here that we can target. What we see is that displacement occurs, CB, market retrace into that, boom, there it goes. Another CB, market retrace into that, there it goes. And that's how we can detect whether or not the market is going to expand lower, even within a very choppy left side of the curve. The moment that the first CBs begin to form on the right side of the curve, it's the sign that, okay, now the time is right for the market to begin to move. What confirms the change in state of delivery is the closure below this down close candle, because this down close candle is the candle that set up the run above the launch buy side liquidity. So we have a high that forms here by just shallow tapping into the launch high, engineering more buy side liquidity. Low gets formed, higher high, lower low. That down close candle should act as resistance on price now. BCs on the left side of the curve getting violated showcases that order flow has shifted bearish, and therefore we can anticipate lower prices. Notice that this BC lines up with this CB. Your PD arrays, they form based on the left side of the curve. So it means that whenever there's an imbalance on the left side of the curve and we see an imbalance form inside that imbalance on the right side of the curve, it makes that price range a very strong resistance area if bearish. So let us now take a look at another example where launch was an expansion. What we can see here is that the launch high was engineered above here and the launch low was engineered below here. At 1 p.m. the market repriced higher inside of these two up-close candles. Market leaves equal highs intact. You do not need to go into the lower time frames to see that these wicks are relatively equal. What this does is that it engineers more sell-side liquidity relative to the launch sell-side liquidity. So you can see that the true day open is just in front of it, but what you can see is that these bodies are equal and next to that the wicks are also nearly equal. What occurs is that the market runs on its sell-side liquidity, trades into the open of this candle, which is a bullish rejection block, market rejects that, and then it draws higher towards the buy-side liquidity above these highs, and into what? Into equilibrium or even premium of the launch range from high to low. Because here's the range. Premium discount. And what we see is that there's a CB that was yet to be traded into inside of a premium. And at what time did that CB get repriced into? Right before the market goes. And that just shows how IPDA, how the interbank price delivery algorithm, has certain price levels that it has to deliver during each session before the market closes. Here you can see the 1 minute time frame, and as you can see, between 1:30 to 2:30 p.m., market traded deep below the launch sell-side liquidity here, and then around the end of a point of interest, or a time of interest, I must say, you can see that displacement higher occurs and buy-side delivery unfolds. You might be wondering, what confirms that the change in state of delivery occurs here? First of all, this up-close candle being broken signals that a change in the state of delivery is occurring. The reason why this up-close candle is significant is because this up-close candle, this high, was utilized for the final repricing lower here near the end of our time of interest. And when we see that up-close candle get violated and we would then see BCs get respected after that, we know that order flow is bullish. And from there on, we can say, okay, while the order flow is shifted bullish, now any retracement can be bought. This doesn't mean you have to buy it here. You can buy it here, you can buy it here, you can even buy it here, you can even buy it here. As long as the range between point A, wherever your entry is, to point B, which is here, the buy-side liquidity above these highs. Why those highs? Because it's the previous cycle's highs. Why? 1 to 230. It already did its job on the downside, so there's no sales liquidity that has to be taken again. What's the first target? The previous cycle's high. And even that 15-minute imbalance. And from there on, we see very choppy buy-side delivery occur towards the buy-side liquidity. Second candle that got violated on the left side of the curve that signals bullish order flow was this big up close candle. Why that big up close candle? Well, notice that this big up close candle's low formed inside of here. Market gets repriced higher. Then the market displaces below that low. Up close candle gets delivered, repricing higher, immediate rebalance here. Whenever this up close candle gets violated, you do not want to see that get broken, because what do we know? What was shared during this lecture. Up close candles should act as resistance if the order flow is bearish. Down close candles should act as support if the order flow is bullish. Here comes something for you to investigate. When these candles do not fulfill their function when it comes to what I just shared with you, the opposite occurs. So instead of that candle now acting as resistance, because it already got broken through, you are looking for that up close candle to act as support on price. Let us now take a look at a new topic during this presentation. We're going to take a look at the topic called SMT relative to PXH or PXL. The name already basically says it, but I'm going to share with you something that will explain to you why certain purchase on liquidity do not occur on the market that you're currently looking at. Because if we take a look at the following charts, I want to ask you, why would price not take out the orange sell side, the orange low right here, before reverting towards the orange buy side liquidity? I'm going to give you a few seconds to think about it, and then I'm going to answer it to you. Please pause the video if you did not think about the answer just yet. During this series, I have not discussed the topic of intermarket relationship or SMT just yet. It will come soon. I will share more insights on it during the next lecture, because we will refine the model during the next lecture and we will add extra tools to it that increase the level of precision. But the reason why the launch sell side was not purged, why this launch low was not taken out before reverting towards the launch buy side, was because of the following. A highly correlated market, because this is the Nasdaq, a highly correlated market to the Nasdaq took out the launch low, whilst Nasdaq created a higher low, so that signals SMT, or cracking correlation between those highly correlated markets. And when it occurs near a point of interest, so in this case near the launch low, we can anticipate that they will leave that launch low intact before reverting higher if we are anticipating higher prices for the session. Here we can see the Dow Jones, and the Dow Jones created lower lows right here, whilst Nasdaq created higher lows, and this confirmed the delivery that was likely to occur on Nasdaq to draw towards the large buy side liquidity. And let us now take a look at another example. But instead of taking a look at 90-minute cycles, their lows and highs, we're now going to take a look at sessions, so complete trading sessions. What we can see is that the red box represents the London session, whilst the green box represents the New York AM session. And what we see is that on the left side, on the left chart, we can see that ES made a lower low, whilst Nasdaq made a higher low. And within the right context, within the right narrative, this is the confirmation that higher prices are likely to be next. And for the people that are paying close attention, this chart has actually been discussed on the lower time frames during the AM session examples. And this is another confluence that can be added to the already existing rules of a model. But more on that during next week's lecture, where we will fine-tune the model and where we will take a look at extra things that can be added, extra saucy stuff that can be added upon the already existing rules. I want to give you a homework assignment before going into next week's lecture. First of all, I want you to take a look at historical charts through the lens that I'm sharing with you and that I have been sharing with you thus far. I want you to take a look at 3 steps. First of all, point of interest, meaning that you must determine a point of interest after you have already determined, of course, the order flow, if the market is bullish or bearish. Once you have determined your point of interest, you're waiting for your point of interest to be reached during the time of interest, during the right time of day, and we're then going to wait for a change in the state of delivery. I want you to really pay attention to what confirms a change in the state of delivery. During this lecture, multiple gems were shared and have been shared when it comes to how you can determine the order flow, how you can detect changes in the state of delivery. Pick which one you like and start putting emphasis on that. So basically pick the one that makes sense to you. This could be the creation of a bullish order block. This could be the violation of upclose candles on the left side of the curve if bullish. Or this could be the disrespect of downclose candles on the left side of the curve if bearish. There are so many things that you can utilize to determine order flow and determine whether or not the change in state of delivery is occurring. Pick the one you like and start paying attention to that. One that might work best for you is the inversion for value gap and the breaker. But anyhow, I want you to begin collecting data for in what point of interest reversals take place and at what exact time these reversals take place. I want you to try and collect as many examples as possible, and you should strive for 30 plus at least before watching the next lecture, because it's important for you to put in the work. You cannot treat the series, as I outlined earlier on, as just Netflix. You need to go into your own charts and you need to put in the work. You need to put in the required effort if you want to gain the benefits from this knowledge, because simply watching a lecture is not enough. As outlined during next week's lecture, we're going to add rules to our already existing rules, and we're going to fine-tune the model. I want to thank you for watching this lecture. I hope that you found it insightful, and I look forward to speaking to you in the next one.